Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. It's my pleasure to present this fourth in a series of 5 articles and videos on 50 fairly valued dividend growth stocks. With this particular segment, I'm going to focus more on total return than yield. My first research candidate is Dick's Sporting Goods. It is the highest yielding of this particular group, offering a current yield of about 2.8%. Sells at a very low blended PE ratio of 10.7. It has only 3% debt to capital, which is one of the things that I'm really focusing on as I'm looking at this particular candidate. What I'm really offering here is what I would consider a special situation. If you look at the long-term track record of Dick's, interestingly enough, it has dramatically outperformed the S&P 500 on both a dividend income and a capital appreciation point of view. However, that's not been the case in more recent years, as you can see this very strong reaction to a couple of things that I think are going on. Of course, you've got the Amazon threat that everybody seems to be so focused on, but you also have some weakening in earnings here for fiscal years 2017 and 18, which is, of course, ends in January of 2018. So what we have here is a tremendous overreaction, in my opinion, to a company that's having a moderate stress in their operating earnings. I call this a special situation because I think it's really a valuation play at this point. The stock has fallen far below what I believe earnings would justify, and I'm going to talk about that in a little more depth. I do want you to notice when it got down to its low PE of 8 in October, we've had a very nice rally in the stock. However, more recently it's been a little bit weak, but I believe this stock is worth 15 times earnings, and if that were true, then we're looking at a pretty good opportunity for the remainder of this year. You could see capital appreciation grow by over 37% this year and a total annualized rate of return of 51%. Of course, that's based on, less than a year's time, primarily on the stock moving back into a more normal or rational PE of 15. If the stock traded at its historical normal PE of around 19, you could actually see a doubling of your money. So I'm going to talk about what are the prospects for that happening going forward here. So next I've moved into operating cash flow here, and you can see the company has historically traded at about a 10.5 price to operating cash flow. And once again, if it was to move back into that normal cash flow, the opportunity or the future rate of return for the next year, for this year, would be absolutely astounding. But that's not really what this particular segment is about. What I really want the reader to see here is this company generates very strong operating cash flows, and its dividend is extremely well covered. Remember, the company only has 3% debt to capital. Dick's Sporting Goods also generates significant amounts of free cash flow that is more than adequately covering their dividend. However, since this is a special situation in my mind, not just the classic dividend growth stock you'll see in the remaining of this video, let's go into the financial underlying numbers and take a look under the hood of Dick's. The first place I want to look is at gross and net profit margin. There's been a lot of talk about weakening margins in this particular company. However, I would argue that the margins are actually reasonable, and these are annual margins here. This is through the year ending January of 2018, and their net margin was actually 3.77%, up from 3.63% in 2017. But there's a part of this that I think is really important. Here I'm looking at the company's revenues per share, and I want you to notice very strong growth in revenue per share in spite of the fact that their quote-unquote operating margins have shrunk in the minds of some people a little bit. Let's look at their quarterly revenue for the last 12 quarters. And what I really want you to notice here is that we are now into what is traditionally the weakest quarter for Dick's or most retail stocks. Their biggest quarter is obviously their last quarter. Of course, remember, this ends in January. So their January quarter in 2016 was a great quarter. Their January quarter in 2017 was a big quarter. And of course, their January of 2018 was one of their better quarters. With this next screenshot, I'm taking a look at common shares outstanding. And one of the things that I like to see is when valuations get low, the company is buying back shares. Here you can see they've reduced their share count from 96 million in 2014 to 78 million for fiscal year ending January of 2018. But I also want you to notice when their valuations were high, they were actually issuing shares. Now, I think that's good stewardship on the part of management. You raise capital when your valuation is high, and you buy back shares when the valuation is low. And I think that's going to support earnings going forward. Now, previously I talked about revenues per share, but now I'm looking at gross revenues here because, as I mentioned a minute ago, they've been reducing their share count. But regardless of that, the company has been growing revenues very nicely. And then finally for this segment, I want to take a look at capital expenditures. And Dick's has been investing aggressively. You can see their capital expenditures have been increasing. They've started opening stores again, but even more importantly, they're really working on their own proprietary online sales distribution channel, which I think is a long-term plus for the company as well. So to summarize and conclude this rather lengthy discussion of Dick's, I want to go ahead and look at forecasts going forward. It is true that Dick's is forecast to have a negative earnings growth this year, and I talked about that. Part of that is CapEx, part of that is margin pressure as a result, but revenue growth is still there. The company's forecast to grow about 5% in the fiscal year ending January 2020, following a negative growth rate in 2019. But I do want to take a look at the long-term trend line growth rate. There are 4 analysts who are forecasting the median forecast of 9.29%. Incidentally, I might add the low forecast is for 6% long-term growth, and the high forecast is for 15%. So there is a certain amount of positiveness looking at Dick's going forward. And I might also add that when you look at their analyst scorecard, the company has had a pretty good record. All in all, they did miss 33% of the times, analysts did, when they're making the 2-year forward forecast, and they missed an equal 33% of the time for the 1-year forecast. But that was for 2016. They beat estimates in 2017 and then did come in below analyst estimates in 2018. But again, part of that was for some of the action and the money the company was spending. So I'll end this by saying I'm really not sure how fast Dick's is going to grow in the future, whether it's going to be the 9% long term or, something higher or something lower. The one thing I feel very confident of, this is a real special situation in that the stock is excessively cheap, and even a no-growth stock ought to be trading at 14 or 15 times earnings. And if you apply that kind of growth, then this company does have some great potential, at least for the short to intermediate term and possibly the long term as well. My next research candidate is Franklin Resources, and it's a somewhat cyclical company, although the Franklin Templeton funds are one of the oldest and most revered mutual fund companies out there. The key attribute that attracted me to this stock right now was what I consider to be, again, an excessively low valuation, very similar to what we saw with Dick's. The company's A+ rated, only has 7% debt, and I think has some really interesting prospects going forward as a long-term and intermediate term total return candidate. If you look at the 3 to 5 year forecast trendline growth rate, it's about 8%. That would indicate, if it traded at a 15 PE, about a 16% annualized rate of return with a nice dividend along the way. My next research candidate is what I consider to be the quasi or semi-cyclical Cummins Inc. Obviously best known for their diesel engines. You can see there is an element of cyclicality in this company, but there's also a very high correlation of price to the company's earnings. And when earnings flatten or get weak, we get into low valuations. They've got extremely undervalued in January of 2016. Earnings have improved a little bit in the more recent years, and the company is currently available at a 14.9 blended PE with a dividend yield of 2.6%. The company's track record is excellent over the long run. It's dramatically outperformed the S&P, substantially on dividend income, but also on capital appreciation and total annualized rate of return. I do consider this a double-digit total return opportunity in the long term. 3 to 5 year trend line growth is forecast to be double digits at 12%. This would again indicate double-digit returns going forward. I do want to point out there is some cyclicality that you might have to deal with along the way, but we got a nice yield, very low debt, A+ rated. I think this is an excellent long-term candidate at these levels. My next candidate is RPM International. Once again, you see this extremely tight fit of price to earnings over time. We see the effects of high valuation and what the reversion to the mean in 2016. We saw it again in 2007-18, which led to the current recent drop in price. We do have a expected moderate acceleration in earnings going forward to the 8 or 9% range going forward. The long-term trend line growth is about 10%. I wouldn't call this the best valued candidate in the group, but it's still attractively valued and does offer some decent long-term return potential. Company's BBB rated, has 57% debt. If you're not familiar with the company, it's probably best known for its Rust-Oleum products. My next research candidate is the jam manufacturer J.M. Smucker Company. Again, you can see very nice earnings growth, moderate cyclicality, but very minimal. A great dividend record. If you look at the company's long-term track record, you can see that their dividend has grown by about 10% per annum. The company has dramatically produced more income than the S&P 500 over this time frame, as well as a much higher capital appreciation. The time to buy stocks is when there's bad news, and of course I don't see anything really bad here. I see earnings doing well. I just think this was a high valuation that is now reverted to the mean, and it remains attractively valued going forward. There's a lot of potential in this company for long-term rates of return going forward. The 3 to 5 year growth forecast is over 12%. That would indicate significant double-digit return, so this is more of a total return candidate than it is a current income, but it does offer a 2.6% current yield. With my next research candidate, I turn to O Canada and I look at TFI International, a trucking company that a lot of you may not be familiar with, but it does package and courier, also does less than truckload and full truckload delivery. What I found interesting in this company was really the last 10 years, but most importantly, this expectation of extremely high growth in 2020. I think that'd be worth trying to figure out why that growth might be there. If you look at it going forward with this, acceleration in growth, it would be a double-digit return generator. The company's historical record has been very good, even recently since December 31st of 2010. It's outperformed the S&P on total income. It's also produced higher capital appreciation than the S&P on both just pure capital appreciation as well as total return. So this to me looks like a very interesting candidate that's trading at a normal valuation of about 15.5 times earnings. My next research candidate is the Duck, Aflac Incorporated. Since coming out of the recession, this stock has remained chronically undervalued. If I shorten this time frame here, you can see that it's been trading about a 9 or about a 10 PE ratio. It's currently trading at 12.6, which looks higher than historical norms. But I think if you look at this long-term perspective, this stock has been significantly undervalued. But even though it's been undervalued, it's still, I'm not going to go to the very bottom here. I'm going to just pick a time frame here where it was trading at an 11 PE, and over this time frame it's averaged over 9%. This stock is one that I'm long in. I've been patiently holding it. I see it getting closer and closer to a final reversion to the mean, but I like Aflac going forward as a long-term hold. If you look at the normal multiple of this company, it could look moderately overvalued to you, but if you look at a normal PE of 15, this could generate really substantial rates of return, and that appears to be occurring in recent time. My next research candidate is Ameriprise Financial. It's an asset and custodian firm, another financial. Once again, I see this very clear relationship between earnings and price. You can see the best time to buy is when the price was below the orange line, as it is today. It looks very attractively valued at a PE of 12.6, has a 2.3% dividend yield. It's A-rated with 43% debt to capital. Forecast growth this year is considered to be very high by 11 analysts at over 40%. If that were to come to pass and the stock traded at a PE of 15, that would represent almost an 80% rate of return this year. It would still average over 35% over the next 2 years or so, and over 23% out through 2020 if the stock trades at that multiple. If it trades at a more normal 14.1 multiple, it still has the potential to generate an annualized rate of return of over 20% per annum. My next research candidate is Comcast Corporation, the cable and satellite provider. I found this company very interesting to look at when I looked at it. First of all, I want you to notice this company commanded very high PE ratios starting, from the end of the irrational exuberant period, but it stayed very highly valued. But notice this slight reversion to the mean. Interestingly enough, as we came out of the Great Recession, the company instituted its first dividend of 15 cents, and that dividend has grown very nicely, averaging over almost 20% growth. They've produced more dividend income since 2008 than the S&P, and they've substantially outperformed it on a capital appreciation basis and substantially outperformed it on a total annualized rate of return. And that's in spite of the fact that the stock has fallen into a low valuation relative to its growth rate. Notice here that the PE ratio of this orange line is a PEG ratio of 1 or equal to its growth rate of 17.2. The company appears undervalued on that basis. If I look going forward, it's forecast by quite a few analysts that follow it to grow at 19% this fiscal year, another 11% next fiscal year. That would generate double-digit returns out for the next several years on this company. The company's A- rated, has 43% debt to capital, and offers a 2.3% dividend yield, slightly higher than the S&P 500. My final research candidate is AmerisourceBergen. I do want to take the price and the normal P off of this graph, and I want you to know that this company has had an excellent growth rate of over 17%. The orange line here is not a PE of 15, it's a PE of 17.6. And when I put monthly closing stock prices on the graph, you can see the very high correlation, and you can see that buying it when valuations are low are optimal, and compared to buying it when the valuation got high as it did in March of 2015. That led to underperformance, a negative rate of return over the last 2+ almost 3 years of minus 6.4%, but the stock now appears to be very attractively valued. It does have a little bit of debt, 61% debt. It's A- rated, but I think what's really interesting about this company is that, with Amazon kind of alluding to the fact that they may not be getting involved in healthcare too much, a lot of healthcare stocks have had some pretty nice rallies here in the last couple of days. And Amerisource is one of those companies. So that concludes my video for this particular Part 4 series. Most of these stocks I'm looking at more for a total return opportunity. I did highlight and spend a little extra time on DICS because I consider that a special situation. But I think there are some really attractive buys here and more oriented to the investor who's looking for a higher total return that might be still a few years or more away from retirement and is more interested in total return than current income. But I think there's a lot of good candidates here. I hope you enjoyed this and look forward to presenting the 5th and final part soon.